You ever just stare at the financial markets? All those flashing numbers, the charts, the news constantly streaming, and just feel completely overwhelmed.
Oh, absolutely. It can look like pure chaos from the outside.
Right. Like it's all just luck. Or maybe only a few insiders really get it. But what if?
Yeah.
What if there's a more deliberate way? Maybe even like a scientific approach.
That's exactly what we're digging into.
Welcome to the deep dive. Today we're jumping into what we're calling the swing trader's execution playbook. And look, our mission isn't about finding some secret magic bullet strategy. That's not really the point.
No, not at all.
Instead, we want to unpack the actual process, the meticulous stuff that successful traders use for consistent profitability. We want to turn that feeling of chaos into something, well, systematic.
Process-driven.
Right. We've looked at a bunch of expert analysis, including some really detailed stuff from the stockoMJ blog, to give you that professional grade perspective. Okay, so let's unpack this. What if we could look at the market, not as a gamble, but more like a series of controlled experiments? Today, we're pulling back the curtain on how successful swing traders really build their edge.
It's true, and that fundamental shift, the one towards consistent profit, it's not really about predicting the next big move perfectly. It's much more about systematic execution, rigorous risk management.
So less predicting, more process.
Exactly. Success isn't about stumbling onto the perfect strategy. It's about having a well-defined, repeatable process that you stick to.
Okay, so it sounds like we're swapping the crystal ball for, like, a lab coat, being a market scientist instead of a market psychic. And our sources say the core of this is the trade thesis, basically a hypothesis you can test.
Precisely. A falsifiable hypothesis.
Can you break that down? Why is that so crucial?
Well, think about it like a scientist, right? They form a hypothesis they can actually prove wrong. A professional trade, it's never impulsive. It's always the execution of a specific plan, a falsifiable hypothesis.
Your whole plan defined up front.
Exactly, before you put a single dollar at risk.
Yeah.
And it has these 4 critical parts. First, the setup. That's the pattern you recognize, the market condition you're looking for, maybe a stock consolidating in an uptrend, something like that.
Okay, the pattern.
Second, the trigger. This is specific. Objective. It's the event that says go, like price closing above that consolidation range, maybe on good volume.
Got it. Setup, then trigger.
Third, the target. Your profit goal, defined before you enter, could be a price level, could be based on, risk reward like 2R, 3R.
Makes sense. And the last piece, you said it was critical.
The invalidation point, yes.
Ah, okay. This is where that science analogy really hits home, isn't it?
Absolutely. The invalidation point is simply the price level, where your original idea, your thesis, is definitively proven wrong. And you have to know this before you trade. It tells you exactly where your stop loss goes.
So every trade is like a little experiment.
A controlled experiment. You know what success looks like, your target, but maybe even more importantly, you know exactly what proves your idea wrong before you start. That's how you manage emotion, keep losses contained.
That is powerful. It shifts the loss from being this personal failure to just dissipate information for the next trade.
Okay, so we've laid the groundwork for managing risk with that invalidation point. Let's talk about actually getting into the trade. There's this big debate, right? Breakout versus pullback. Confirmation versus price.
Yeah, it's a fundamental trade-off. Breakout entries, they prioritize confirmation. You wait until the price actually moves through a key level like resistance.
You want proof first.
Right. You accept maybe a slightly worse price, but you get that sense the market's likely moving your way now. It's common in momentum trading.
Okay. And then pullback entries are the opposite focus, aiming for a better deal.
Exactly. Pullbacks prioritize a better price and therefore better risk reward. You're buying during a temporary dip within an established trend.
So lower entry, tighter stop. Potentially, yes. Which means you can often size up the position a bit for the same dollar risk. That boosts your potential profit relative to the risk. The trade-off. Less confirmation. You're betting the pullback is just a pause.
Breakouts for confirmation, pullbacks for value. Is there like a middle ground? I heard about role reversal levels. How do they work?
Yeah, this is where it gets really interesting. Role reversal levels. So picture a stock finally breaking through strong resistance. A ceiling becomes a floor.
Okay.
Instead of chasing that breakout, the pro might wait. They know that old resistance often becomes new support. So you get the confirmation of the break, but then you wait for the first pullback to test that level as support.
Ah, so you get the confirmation and a better price on the retest.
Exactly. You get the market validation, but you enter on your terms at a better price, usually with a clearer spot for your stop just below that new support. It really brings up a key question for you listening. Which fits you? Your risk tolerance, the setup you're seeing right now.
Good question. Okay, so you're in. Now what? The exit. Just as crucial, I imagine, and probably just as planned.
Absolutely. The sources are clear. Exits aren't random guesses. They need a predefined logical framework. They have to be a direct consequence of your original thesis.
So what are the options in that framework?
Well, several. Target-based exits are pretty straightforward. You set a specific price target beforehand, maybe based on that R multiple, maybe a technical level, and you exit when it hits. Objective. Takes emotion out.
Okay, hit the target, get out.
Then you have structure-based exits. These are more adaptive. You stay in as long as the trend structure holds. For example, in an uptrend, you might exit only if price closes decisively below the most recent significant swing low. Lets you ride trends longer.
What if the trade just stalls? Doesn't do anything?
Good point. That's where time-based exits come in. You decide if this doesn't work out within X days, I'm out. It's a critical backstop, especially for things like mean-reversion trades that should snap back relatively quickly.
Right. If it's not reverting, the thesis is failing.
Exactly. And finally, trailer concepts. This is using a dynamic stop loss that moves up as the price moves in your favor. Think trailing below recent lows or using an ATR multiple, locks in profit, but still gives room to run.
These trailing stops sound smart for letting winners run, but it all comes back to that invalidation point, doesn't it? The stop loss isn't just about pain, it's testing the hypothesis.
It absolutely is, and that mental shift is huge. The stop loss isn't failure, it's an objective tool answering. At what price is my original idea wrong? For a breakout, maybe it's just below the old range. For a pullback, just below the pullback low.
So when it gets hit?
It's not personal, it's data. You take the small, managed loss, preserve your capital, preserve your sanity, and you move on.
That reframing is key. Okay, core ideas down, let's get specific. Momentum trading. Winners keep winning. How does that work in practice?
Right, momentum trading. You're trying to capitalize on stocks already showing strong trends. Works best when the market itself has a clear direction. The core idea is that strength often begets more strength, usually driven by institutions piling in.
So how do you actually, get on board these moving trains?
Two main ways. First, breakout from consolidation. Stocks already trending up, pauses, consolidates maybe on lower volume, then bam. It breaks out above that consolidation resistance, ideally on a big volume surge. That's your entry trigger.
Confirmation of the trend resuming.
Exactly. Second, pull back to key levels. Maybe you missed the initial break, so you wait for a shallow, orderly pullback within that uptrend. You look for support, maybe a moving average like the 20 or 50 EMA or that roll reversal level we talked about. You enter when you see a confirmation signal there, like a bullish candle.
And managing the exit. You want to ride the momentum, but not give it all back.
Adaptive exits are crucial here. Trailing stop losses are probably your best bet. As the stock makes new highs and pulls back slightly, you move your stop up below the most recent significant swing low.
Keep ratcheting it up.
Right. Or you could use an ATR trail or trail below a key moving average. If the price breaks the trend structure, say, a sharp close below the last important higher low, that's your signal momentum, might be done. That's a structure break exit. Initial stop, though, always back to that invalidation. Below the consolidation for breakouts, below the pullback low for pullbacks.
Makes sense. Now let's completely flip that. Mean reversion trading.
Yeah.
Fading extremes sounds like the total opposite.
It kind of is, philosophically. Mean reversion banks on the idea that prices, when they get stretched too far from their average, statistically tend to snap back. Works better in choppy, range-bound markets where clear trends are absent.
So you're looking for things that are overdone, oversold, or overbought. How do you spot the entry?
Often with statistics or oscillators, statistical deviation entries, like using Bollinger Bands. Price stretches way below the lower band, that's the extreme, then closes back inside the band, that's often the trigger. Or maybe using z-scores to find statistical outliers.
And oscillators.
Yeah, oscillator-based entries. Think RSI. It drops below 30, super oversold, then it hooks back up above 30. That hook can be your entry signal. Stochastics crossing up from below 20 is another classic one.
I've also heard about a swing failure pattern, or SFP. That sounds intriguing. What is it?
The SFP is clever. It's a reversal pattern that basically traps other traders. Imagine price dips just below a key support level, shorts jump in, thinking it's breaking down.
The breakdown artists.
Exactly. But then, whoosh, price rockets back up and closes above that support level. It faked them out, trapped the shorts. You enter long on that rejection, betting against that failed breakdown. It can be a powerful reversal signal.
So how do you get out of a mean reversion trade? Holding too long seems like it defeats the purpose of reverting.
You're right. Exits have to match the thesis. Get back to the mean. So target-based exits are really common. Your main target is often the mean itself, like the 20-period moving average.
Makes sense. Return to average.
Or indicator-based exits. If you entered on RSI hooking up from below 30, maybe you exit when RSI gets back to 50, the midpoint. And definitely time-based exits. If price hasn't reverted in, say, 5 or 10 days, the thesis is probably wrong. Get out, even if it's a small loss, stop loss. Needs to be beyond that extreme point, like just beyond the low of that SFP wick, protecting against it, turning into a real breakdown instead of just a fake out.
Okay, switching gears again. Event-driven and catalyst-based setups. Trading the news right, anticipation or reaction.
Correct. Capitalizing on the extra volatility around specific events, earnings, mergers, FDA news, that sort of thing. And yeah, there are two main ways to play it.
Let's start with the anticipation part. Pre-event catalyst trading. Buying the rumor.
This is betting that positive buzz before an event will push the price up. You find a stock with a big catalyst coming up on a specific date, look for signs institutions are buying in advance.
Okay, but the exit.
Critical. The position must be closed before the actual event. Holding through earnings or an FDA announcement, that's not trading. It's gambling on a binary outcome. You trade the run-up, the anticipation, then you get out.
Got it. Trade the hype, not the coin flip. What about after the event? Post-event drift trading, or PED.
Right, PED. This exploits a known market tendency. Stocks often underreact initially to big earnings surprises and then drift in that direction for weeks, even months.
So the market takes time to fully price it in.
Seems so. You look for big earnings beats or misses, let the initial crazy volatility settle down. Then you look for an entry, maybe a breakout from the post-earnings consolidation range or a constructive pullback.
And exits for PED.
Often time-based, maybe hold for 5 to 20 trading days. Or structure-based, if that post-earnings trend breaks, you're out. A common stop is a close below the low of the actual earnings announcement day candle. That invalidates the drift idea.
Okay, fascinating. Next, rotational trading setups. Riding the institutional flow. This sounds bigger picture, more macro.
It definitely is. Rotational trading is about aligning yourself with the big money moving between market sectors. The idea is simple. Find the strongest stocks within the strongest sectors in a market that's generally cooperative.
You're trying to swim with the biggest currents.
Precisely. You're essentially acting like a market strategist. Why fight uphill in a weak sector when you can find opportunities where institutions are clearly putting money to work?
So how do you actually do that? Sounds like top-down.
It is a very systematic top-down analysis. First, check the market analysis. Is the overall market healthy? Like, is the S&P 500 trending up? Second, sector analysis. Which sectors are outperforming the market? Use relative strength, compare a sector ETF like XLK for tech against the SPY, find the leaders.
Okay, market, then sector.
Then finally, stock selection and entry. Dive into those leading sectors. Scan for the individual stocks showing the most strength and setting up in good technical patterns. Remember, a perfect setup in a junk stock in a weak sector is usually way worse than a decent setup in a leader within a hot sector.
Context is everything. And the exits must reflect that multi-layer approach too.
They do. You exit if the alignment breaks down at any level. Stock level weakness. The individual stock's trend fails. Sector level weakness. The whole sector starts underperforming the market. Its relative strength rolls over. Or even market level weakness. The S&P 500 enters a correction. Any of those can be a signal to exit.
What about position sizing here? If you have, say, 3 tech stocks in a portfolio because tech is leading, isn't that concentrated risk?
Oh, incredibly important point. Yes, it's highly correlated risk. Thinking you have 3 separate 1% risks is misleading. If tech rolls over, they'll likely all go down together.
So how do you manage that?
You have to think about risk at the theme or portfolio level. Instead of risking 1% on each of those 3 tech stocks, maybe you allocate a total risk of, say, 1.5% across all 3 combined. You distribute the thematic risk. That prevents one sector dip from blowing up your account.
Smart. Okay, we've got setups covered. Let's talk advanced in-trade management. Stuff happens between entry and exit, like gaps. Swing traders must deal with overnight price jumps, right?
All the time. It's part of the game. If you get a favorable gap up, great. Is it a gap and go? Maybe hold if it's on high volume, breaking resistance. Use the low of that gap day as a new tight stop, or Are you fading the gap? Maybe take some profits if it gaps right into major resistance or looks really extended.
And the bad gaps. Adverse gap down.
More serious. If it gaps through your stop loss, you don't hesitate. You exit immediately at the market open. The thesis is dead wrong. If it gaps down but holds above key support, maybe you hold on, but that gap days low becomes your absolute last chance stop.
Okay. What about adding to winners? Scaling in or pyramiding? Sounds like doubling down.
Go carefully.
Very carefully. This is for high conviction trades that are working strongly. But the rules are strict. 1, only add to winners. Never losers. No averaging down into trouble.
Rule 1, crucial. 2, decreasing size. Each add-on should be smaller than the last. 3, logical addition points. Each addition needs its own valid technical trigger, like another small breakout or pullback setup. Treat it like a new mini trade.
And rule 4.
And this is critical. Trail the entire position stop aggressively. When you add, you must raise the stop loss for the entire combined position, maybe to the break-even of the newest piece or even higher. Protect those accumulated profits.
That protects the whole thing. Okay. And the opposite, taking partial profits, scaling out. What's the thinking there?
This is about locking in gains and reducing stress. Sell parts of your position at predefined profit levels, like sell a third at 2R profit, move your stop to break even on the rest, sell another third at 4R, let the last third run with the trailing stop.
What's the main benefit, besides banking profit?
Huge psychological edge. Locking in some profit makes it way easier to let the rest run for a bigger gain. It reduces the fear of a winner turning into a loser. Less pressure.
Makes sense. This all sounds pretty active, entering, exiting, scaling. But I've also heard that sometimes the absolute best thing to do is nothing. Flat is a position.
Oh, massively important. Patience is a superpower. Your edge, your high probability setups, they aren't there every single day. Forcing trades when the market is choppy or directionless, that's just asking for losses, death by 1,000 cuts.
So sitting on your hands is okay.
It's more than okay. It's a strategic decision. Being in cash, being flat, is an active position. It preserves your capital, sure, but just as importantly, it preserves your mental capital. Lets you wait calmly for the really good opportunities. You don't get paid for activity. You get paid for being right at the right moment.
That's a perfect segue into risk architecture and psychological guardrails. Because all these cool tactics mean nothing if you can't execute consistently, right?
Exactly right. You can have the best system in the world, but if you can't follow it, it's worthless. Consistent execution demands a strong framework for discipline, capital management, and fighting your own brain's biases. We're all prone to self-sabotage.
So what are those big psychological traps we need to set guardrails against?
Oh, there are classics. Chasing jumping in late because of FOMO, fear of missing out, leads to bad entries, bad risk reward. Then there's stop creep. Your trade goes against you, hits your stop, but you move the stop further away, hoping it'll come back. That's loss aversion biting you, turning small, manageable losses into disaster.
Yeah. Move the stop. Deadly.
Totally. And thesis drift. You enter a trade for one reason, say Mean-Reversion. It goes against you, but instead of stopping out, you suddenly decide, oh, maybe it's a momentum trade now. You're changing the rules mid-game to avoid taking the loss. Your initial plan has to be your anchor. Plus, overconfidence after a win, recency bias, confirmation bias. They're all working against you.
So willpower isn't enough. How do pros build actual systematic guardrails?
Correct. Willpower fails under pressure. You need systems. The absolute foundation is the 1% risk rule. Maybe 2% absolute max for some, but 1% is better. Maximum potential loss on any single trade cannot exceed 1% of your total account equity.
Non-negotiable.
Absolutely non-negotiable. This is what keeps you in the game. It lets you survive drawdowns, which will happen. It's the ultimate capital preservation tool.
And how do you make sure you stick to that 1%?
Through position sizing models. Simple fixed fractional sizing calculates how many shares to buy based on your entry, your stop-loss distance, and that 1% dollar amount. So wider stop means fewer shares, tighter stop means more shares, but the dollar risk stays the same.
Consistent risk per trade.
Exactly. Some use more advanced volatility-based sizing, like using the average true range, ATR, which adjusts position size based on how much the stock typically moves. It helps normalize risk across volatile and less volatile stocks.
Okay, 1% rule, position sizing. What else helps enforce discipline?
Two huge ones. Pre-trade checklists and trading plans. Before you even think about clicking buy, you mechanically go through your checklist. Does it meet all setup criteria? What's the context? Entry, stop, target. Risk reward, okay.
Right.
It forces you to pause, think, and avoid impulsive trades. It's like a pilot's pre-flight checklist.
A break on emotion.
Definitely. And maybe the single most important tool for getting better over time, the trading journal. Meticulously log every trade, not just the numbers, but screenshots, your thesis, what you entered, why you exited, your position size, and crucially, how you were feeling, your psychological state.
Why the feelings?
Because that lets you do data-driven self-assessment later. You spot patterns. Wow, I always seem to chase after a big win, or I tend to cut winners short when I'm anxious. It turns every trade, win or lose, into a lesson to fix recurring flaws.
Wow. Okay, we have covered a ton today, from the core idea of process over prediction, through specific setups like momentum and mean reversion, all the way to these critical risk and psychological guardrails.
It's a lot, but it connects.
It really does.
Yeah.
It's so clear that real swing trading mastery isn't about having a crystal ball. It's about understanding the market's different moods, applying a playbook you've defined, and having the discipline, the unwavering discipline to stick to it. That edge seems to live in the careful plan, the patient execution, managing the trade dynamically, and just unemotionally taking the exit signal when it comes.
That truly is the essence. The strategies are tools, but they only work if you build that solid risk architecture around them and manage your own psychology. Consistent profit is just the outcome of a really good process, executed almost flawlessly day in, day out. It's about being deliberate.
And, these ideas, systematic process, defining failure points up front, building guardrails against bias, they aren't just for trading, are they? They feel like powerful tools for making decisions and managing risk in almost any area of life.
That's a great point. It applies broadly.
We've talked about how pros turn market uncertainty into these controlled experiments, right? Where small losses aren't failures, they're just objective data points. So here's a thought to leave you with. What if you applied that invalidation principle to a challenge in your life? A new project, maybe a career move, a personal goal. What would it look like to define right at the start the point where your hypothesis is clearly wrong? The point where you could say, okay, this isn't working as planned, and then move on unemotionally, saving your energy for the next opportunity that does have a high probability of success. Something to think about. We'll catch you next time on The Deep Dive.